Welcome back to Market on Close. Let's get our big picture discussion in 2025 started with the Schwab team. Joining me, Kathy Jones, alongside Nate Peterson. Nate's a director of derivatives analysis. And Kathy, of course, chief fixed income strategist. Good afternoon, team. Great to see you. Let's get started, Kathy, talking about the big pictures. We just left the credit conversation with Ali there on bonds. Treasury's a little changed on the day, but we did see a general kind of fade from early strength. Take me through what you guys are thinking for the first quarter here of 2025.
Yeah, Oliver, I think as we enter 2025, we're going to see a lot of volatility because there's so many things up in the air. We've got the debt ceiling business to still deal with. We've got what the Fed may or may not do. It looks like the market's pricing out any rate cuts early in the year, and only 2 for the year. And then we have the new administration coming in. We've got tariffs, possible tax cuts, immigration changes, all of which have the potential to be somewhat inflationary. So you mix all that up and you have, a stew pot for volatility. What we think is that, say 10-year yields around 4.50, 4.6, you're probably fairly valued for where we are. But there's a risk probably greater to the upside than the downside in yields because of the potentially inflationary impact of some of these policies.
So then how will you be assessing, Kathy, as the new administration gets underway, kind of what lives up to expectations and what doesn't? What kind of a timeline do we have for bonds if this move is based on those expectations?
Yeah, and that's going to be the tricky part. So nothing moves fast in Washington, as our colleague Mike Townsend always likes to say. Tariffs, we think, are something that could be implemented fairly quickly, so we should find out about those relatively early in the year, in the first quarter. After that, some immigration policy impact. That will take time, but if we get a lot of deportations and a big move early in the administration, then we start to see some of the wage impact of that later in the year, and the market's going to anticipate that. And then with tax policy, who knows? I think that's a ways down the road. It might be a 2026 issue. But nonetheless, as the market looks out, if we don't get the decline in inflation, we don't get a weakness, particularly in the labor market, they're going to focus on these uncertainties, which probably give us more push to the upside than the downside in bond yields.
Okay. Nate, kind of on a similar point for stocks, how much do you think of the equity strength this past year was contingent on policy? How much of that have we unwound? Do stocks have a little bit of a cleaner start now that the S&P is basically sitting right at the post-election gap?
I think, based on that stew pot that Kathy was identifying there, I think we still have a hangover from the December FOMC meeting. I mean, just go back to November and look at the optimism that was in the market, and to see all those cyclicals and all the speculative assets, including Bitcoin, that were just taking off, and the sentiment was just so bullish and optimistic. And then you look at what happened to yields in December leading up to the FOMC meeting. We're up 30 basis points or so there. And I really think it is that reassessment of, wait a minute. I mean, by the way, the S&P today hit the lowest level since November 5th. So we've done a full rally of that whole, post-election optimism back down to where we were at the start of November. And I think that is directly tied to yields. And it is basically reminding the market that yields do matter in terms of risk premium and basically borrowing costs, and what that means for tightening growth. And when you're at a forward PE of 22, yes, we're going to have earnings coming out here in a couple of weeks, and we're looking for 12% growth there. That's more than double than the 5.8% we saw in the prior quarter. But you're going to need a lot to go right at that kind of valuation. So the economy still looks good. The economic data is there, but these rising yields, and technically speaking, if we get above that 4.7% level on the 10-year, which was the high, the 52-week high from back in April, I just think more volatility will be coming back into the market, because you don't have a lot of wiggle room at this kind of valuation.
Yeah, to the point of Ali Melli in the last block, CAPE ratio is looking pretty high. VIX today to 18. Nate, not really super dramatic though, but up is notable, but still 18, not super elevated.
Well, yeah, but we're not that high from, not that off all-time highs. I'd say we're relatively elevated. We saw that big spike on December 18th. We saw those reaching for protection, and I think that level of, cautiousness, at least from institutional investors going out there and grabbing SPX puts and doing all of that, I think that it just paints this picture that there is this tone of we could get a volatility bout here in Q1 at some point. And if you look at the term structure there, we're still going up to 19 when you're getting out to March and April or so. So even at 17, which I would consider relatively elevated, we're still in contango, meaning I think that there's still likelihood that we can get another, decent size pullback. 5 to 8% at some point in Q1 would not surprise me.
All right. And, well, today we might just end even 30 seconds, pretty close, but going to be a little bit of a drop. Appreciate it, guys. Thanks a lot. Great start for us. Kathy Jones and Nate Peterson.